Ever stop and think about who really controls the money in your bank account? It's all part of this huge system with two main players, central banks and commercial banks. Now, they have totally different jobs, but they work together in a way that affects, well, everything, from your savings account to your mortgage. So let's dive in and unpack who's really calling the shots.
To really get why this system even exists, we've got to jump in a time machine. Let's go back to a time before the US had a central bank, and let me tell you, it was a mess, a total mess.
Just look at this picture. This is from the Panic of 1907, and scenes like this, they were depressingly common. You'd have these massive financial panics just rolling across the country, spreading pure fear. Banks would just stop trusting each other. They'd refuse to clear checks from other banks, and that set off this terrifying domino effect. Even perfectly healthy banks could go under. Bottom line, your money was not safe.
So with all this chaos, this constant instability, everyone was asking the same huge question. Who is going to step in? Who can actually stabilize this thing and stop these crises from happening over and over and over again?
Well, the answer was to create something totally new, a kind of super bank, a bank for the government and a bank for all the other banks. And that institution is the central bank. Here in the US, you know it as the Federal Reserve System, or what everyone just calls the Fed. And its main job is not to make money. Its goal is to manage the entire country's financial plumbing.
Okay, so the Fed basically has three main gigs. First, it sets monetary policy. You know, that's when they fiddle with interest rates to speed up or slow down the economy. Second, it's the supervisor for all the commercial banks we use every day, making sure they're playing by the rules. And third, it literally acts as a bank for the banks.
Think of it this way. The Fed is the absolute backbone of the entire US payment system. I mean, every single time you swipe your debit card or a business deposits its earnings, the Fed's machinery is humming away in the background, making it all happen. It's the ultimate middleman. And the scale here, it's hard to even wrap your head around. Get this, in just 1 year, the Fed's FedWire service processed transactions worth over $436 trillion. Yeah, trillion with a T. That is many, many times the value of the entire US economy, all flowing through their system.
And yup, the Fed is also in charge of our physical money. You know, actual cash. They make sure there are enough bills out there for everyone, from getting new ones printed to taking the old, worn-out ones out of circulation and destroying them.
And these old bills right here really show you how much things have changed. See, before the Fed came along in 1913, the US had this crazy, confusing mess of different currencies, like these notes from the 1800s. The whole point of the Fed was to bring some order to that chaos.
All right, so that's the big guy, the government's bank. Now let's switch gears and talk about the banks we actually deal with every day.
These are the commercial banks. You know them, you use them. They're the ones where you have your checking account, where you got your car loan, or the one that issued your credit card. They're businesses, and their goal is to serve you and me and other businesses.
And their business model is pretty simple, right? They want to make a profit. They do that by taking our deposits, giving out loans, and investing that money to get a return. This is totally different from the Fed, which is all about public service, not profit.
So let's put these two head to head. It really helps to see how they're like two sides of the very same coin.
Okay, this chart lays it all out. Look at the goals. The Fed, it's all about keeping the whole economy stable. Commercial banks, they're trying to make a buck. And check out the customers. Totally different worlds. The Fed's customers are the government and other banks. A commercial bank's customers, that's us, the public, and other businesses.
But here's the thing, they're not fighting each other. It's actually a symbiotic relationship. The Fed makes the rules and provides the foundation, and when things get really, really bad, like in a major crisis, the central bank steps in as the lender of last resort. It gives emergency loans to commercial banks to stop the entire system from just collapsing.
Okay, I know, this all feels a little abstract, kind of high-level stuff. So let's bring it right down to earth. How do these big decisions by the Fed actually end up affecting your wallet?
So, the Fed's biggest calls, we're talking interest rates here, are made by this small, powerful committee. It's called the Federal Open Market Committee, or FOMC for short. And believe me, what they decide has huge consequences for everyone.
Here's a quote from the Fed Chair Jerome Powell. He says they look at financial conditions very broadly. What he means is they're looking at the whole shebang. Jobs, inflation, economic growth, all of it goes into the mix when they're making these calls that, yeah, are going to hit your bank account.
So here's how the magic happens. When you hear on the news that the Fed raised interest rates, what they're really talking about is the FOMC. They've just made it more expensive for commercial banks to borrow money from each other. That little interest rate is their #1 tool.
And that one little change sets off a huge ripple effect. Because now it costs your bank more to borrow money. And guess what? They pass that cost right on to you. Suddenly, the interest rates for a new mortgage, a car loan, your credit card, they all start to creep up. The Fed's decision literally flows right down into your wallet.
So, you see, from stopping a total meltdown like the one in 1907, all the way to nudging the interest rate on your next loan, the central bank is quietly, powerfully shaping your entire financial world. So the real question is, are you paying attention?